Hello, I'm Chris Didier, and welcome to the Bear Generational Wealth Group's fourth quarter market and economic update. I'm going to go through the material fairly quickly today, so if anything I should say raises a question or brings up a concern for you, please feel free to give me a call or send me an email. I'm happy to drill down on anything we talk about today. So with that, let's get into it. Okay, so how do we do in the most recent quarter from a market perspective? Well, most asset classes, more risky asset classes especially, performed poorly during the quarter, but quite frankly, all asset classes for the most part performed poorly, with the exception of commodities and cash. Cash did okay as well, but commodities were led by oil, and oil moved up pretty sharply during the quarter, but all the more risky asset classes were down, the less risky asset classes were down as well. The equity market, though, for that's measured by the S&P 500 is still up for the year. But I will say, if you take out some of the top holdings of the S&P 500, mostly the AI-related technology stocks, the equal weight S&P 500 is about even for the year, just maybe up a little bit through the end of the quarter, but probably today's about even. So interesting market dynamic, but we'll see how the rest of the year plays out. So we always like to talk about where we are within the market cycle. This go around, we started the last a couple quarters ago. We were at a fear level, and we came over here to relief, which is where we were at the beginning of the quarter. Well, that quickly faded. We went into market correction through starting in about August this past summer, and quickly moved over to this area of fear. And it's really kind of a growing fear. It wasn't like, one day we woke up and there was another Silicon Valley Bank. It's just that the market started correcting and fear started to build. But this is sort of an environment where it's easier to say where we're not as opposed to where we are. We know we're not anywhere in here on the curve, and we know we never had panic. We definitely never had capitulation. We're not in a place of hope. So that leaves really somewhere between this fear and relief, and we're sort of tilted over to the fear side of things right now. And so how do we know, we're not in something worse than that? Well, you saw the allocations move down a little bit, individual investor allocations. So that was so representative of the fear that was building, but we never got into an area of capitulation or panic. Capitulation is down here. That's when more risky asset classes are around 45%. So we never approached anything like that. The fear gauge says the same thing, although at the beginning of October, this did pop up to above this 20 level, which is definitely an indication of fear. But then it's kind of right back down here. So we still are in this area where we haven't had a big panic like we get like when the volatility index goes up to these levels, or a real huge amount of fear. So we're still in this sort of like, people are concerned, anxiety is built up a little bit, market corrected. But it's still no sign of panic or capitulation. And we saw that in the IPO market as well. And back here when everything was going great, and we had this area before, we had sort of a record level of IPOs going, and then the IPO market pretty much froze up. It started to try to open. There was some like green shoots with some fairly large IPOs that tried to come out. There was Instacart, ARM, Kava, Birkenstock just recently came out, and they floated these IPOs with the idea, well, when maybe the window is opening up here, but they really didn't go anywhere. And so they popped up, kind of traded back to their offering price. Birkenstock, for example, is down about 13-14% from its offering price the other day. And so it's kind of indicative of the idea that we haven't seen the IPO market open up. So when we get to more of an area of optimism, or feeling good going up the other side of the curve, this IPO market will definitely be indicative of that. And so we'll be on the outlook for that. CAPE ratio, which is our measure of valuation, one measure we use, and this one we like because the data goes back. The light blue line going through here is the CAPE ratio, cyclically adjusted price earnings ratio. Data goes back to 1900. We're showing you data from 1990. And really what we're concerned about is where are we relative to the red and the gray line? Because when we're above this line, a new dollar of investment gets about 3.8% return. And when we're below this line, that's when the good stuff happens, because the return expectation goes up above 11%. So that's what we like, but we're right kind of here, sort of in between, in no man's land. And what valuation, so it's gotten better from where it was in the last quarter, but this would suggest to us that investors should sort of stay with their strategic allocations, try to stay close to target, and maybe even add if you're below target. But it's not a time to overweight equities, and it's just, not a time to really be looking to sell a whole lot. I mean, if we should move up sharply and get to this level, then you probably would want to, take some profit on that. If we move down and have a continued correction or get to an area of capitulation, that's probably a time then to add to the more risky asset class. But right now, it's sort of status quo. So what's driving everything? Well, when we look at this is money markets and deposits, bank deposits. And when you look at where we are post 08 relative to GDP, people and businesses and individuals held as a whole in aggregate, about 75% of GDP was held in cash in money markets and bank deposits. Okay, that changed given all the stimulus that came in from COVID. Maybe some level of fear that came in and anxiety from that, but people started holding more cash. And today, they're holding about 80. It's more like about 88% of the GDP is now being held in money markets and deposits. That's a lot. So that's a lot of money that can come in off the sidelines to support the equity market, come from retail money markets into stocks. Right now, investors have been content to hold those in money markets because they're getting 4 or 5% returns on the money markets. And so if you're a little bit concerned, you're going to want to try to wait until you can get maybe higher returns in the equity market. But sooner or later, that money is going to shift into more risky assets where they can get more returns, especially if those rates start to come down. But that $3.2 trillion in cash, that's a lot. And so that's inside of businesses in terms of cash that's built up. And again, it's in retail money markets. So that's going to provide both a cushion for the stock market should it go down further, could provide really an acceleration on the upside as money comes off the outside, and it will provide some cushion as far as the overall economy is concerned. Really though, the thing that's driving it, has been driving the economy is the wealth effect. And the wealth effect is really, how do households feel about their portfolios? Do they have, are their portfolios going up? Is their house value going up? And if those two things are happening, aggregate net worth, household net worth is also going up. And so in the middle here is the gray dotted line is the trend line. Here's where we were right here, right before COVID. And then this is money supply. So this is all the money that came shooting in to the economy, all the stimulus, and that drove household net worth to these huge levels. But that started coming down with the correction. Housing prices started coming down a little bit. As we saw right here, as the Federal Reserve started pulling some money out because they're trying to reduce the wealth effect that's creating way too much demand in our economy. But then this year comes along and house prices each month start to go back up. Portfolios, also have done pretty well overall, and they've gone back up. And so you've got household net worth sitting at a record level. This is $13 trillion, okay, over trend. 13 trillion. That's a lot of extra money that's sitting in the economy, a lot of extra wealth. And so that can continue to cause demand and really be a headache for the Federal Reserve because that extra demand is the demand side of the supply demand equation for inflation. And we see that also. I mean, so given that how people feel about their own personal wealth, personal expenditure have been going up as well. So on trend, so this is real. Okay, this is adjusted for inflation. So real personal consumption expenditures are staying right on trend. So that means that people are out spending money. We saw that this past summer. I mean, a lot of the airlines are reporting record results because people were out traveling, and they weren't doing just regular traveling too. They were doing a lot of luxury type traveling. Even airlines talking about, well, we don't have enough room in business class. We need to expand that because people are willing to spend money. Okay, and one of the reasons they're willing to spend money is that they're out participating in the labor force, and we're seeing that. So we're seeing labor force participation go up. We're not expecting the baby boomers who left the workforce post-COVID to ever return anytime soon, but just in general, participation is finally approaching the levels it was at. Not quite there, but close to where it was at pre-COVID. Job openings have come down, and that's getting a lot of headlines and stuff. But when you look at that, there are still 2.6 million job openings than prior to the pandemic. So the economy is definitely producing job openings and definitely producing possibilities for people to get jobs. But that's creating a tight labor market. So we think this is one of the major, continues to be one of the major constraint sides. So on the supply side of things, that is pushing wages higher and contributing to inflation. And we know that wages over the past couple of years have risen on the 4 to 5% area, and that still is what we're seeing out there right now. And when you think about what happened prior to the pandemic, wages were only rising at 2.5%. So that's considerable upward wage pressure. One of the other big constraints or supply constraints that there is out there for inflation, causing the inflation side of the supply constraint side of the inflation equation, is energy. And so when we look at what the CPI has done over the last few years, we see this chart below. So the light blue is actual results for CPI. The red is just if you maintain current levels of CPI, look out year over year, and that's what the result would be. So if nothing changes, that's what the CPI levels would be. And we know, so back here, so that what this means is that nothing changes. We're going to, 3.4, 3.7%, still well above the 2% target. But this would say, well, we're getting close up there. So that's what's causing some folks to say, well, inflation is coming back down. But if we consider, some of the drivers of inflation, and the one we're looking at right now is the energy. So back here, when inflation was running at 9.1%, X energy would have been 6. That means energy contributed 3 percentage points to inflation. In June, after oil and other energy components dropped, X energy, it would have been 4.5%. And it actually came in headline number 3%. That means that the drop in energy was actually a negative contributor of 1.5%. So right now we're kind of online with that. But if we consider that oil, natural gas have both gone up in the last couple of months since June, we're expecting that year-over-year number to be to have an impact from that, and inflation to be a little bit stickier than what might otherwise be. So it's going to be a real challenge for the Fed to get it down to these lower type of numbers here. So we would expect that to continue. Okay, yield curve. Got to say something about this because people have been talking about it all year. The reason they've been talking about it is that when you have a inverted yield curve, and what an inverted yield curve simply means is when higher rates are actually lower than shorter rates. Longer rates, are lower than shorter rates. Tongue twister, I guess. And so what this chart is showing is the 10-year minus the 3. So when it's below this red line, that means the curve is inverted. In other words, the short rate is higher than the long rate. When it's above here, that's a normal curve. And by normal, so we're again, talking about a yield curve that slopes up like this. Okay, this is time. Okay, this is the rate. Okay, so short rates are low, longer rates are higher. That's a normal yield curve. Okay, what we've been inverted. And so historically, an inverted yield curve is always followed by recession. And we see that in this chart here. But one thing you should note about this, and it's very, very critical to pay attention to this, is the recession doesn't, and these gray bars are the recession, okay, each year. The recession doesn't happen until after the curve normalizes. The curve normalizes here. The curve normalizes. It normalizes even before 2020, the recession that occurred from the pandemic. The curve normalized before that. So until we get up above here, in other words, until longer rates are higher than short rates, we don't expect there to be a recession. But once that should happen, we expect it to be fairly quickly. So if you had to guess when that would be, maybe sometime second half of next year, maybe early in 2025. And, it kind of makes sense because if you look historically, when do recessions occur during the presidential cycle? Going back to the Great Depression, 0 have occurred during the third year of a president's term, and that's what we're in right now with President Biden. The second most that occur are in the fourth, but the most that occur are actually in the first year of a president's term, and that would be in 2025 for whoever the president is at that point in time. And a little bit more about the 10-year, because that's really what's been driving a lot of things and driving some current concern around causing really the correction that's been happening because rates have been moving up. And you see that right here, rates have been moving higher. But prior to this, is the dotted line shows when quantitative easing started, and that was back in 2008. That was how the Federal Reserve helped us get out of the 2008 credit crisis. It's also how the Federal Reserve helped us get out of the most recent 2020 pandemic crisis. But prior to that, interest rates averaged the 10-year 5.4% for 15 years. Okay, since then it's been about 2.5%, 2.48%. And that's because the Federal Reserve has dumped in about $9 trillion into the Treasury market. So they now own 20% of U.S. Treasuries. They own 26% of mortgage-backed securities. So they were the biggest buyer around. Well, in June of last year, they decided to start rolling that off. Some are calling that quantitative tightening, but really it's just an end of quantitative easing. So they've reduced this to 8 trillion now and allowed a whole $1 trillion in the last year and some change to roll off of that. And that's been causing rates to go back up because in the bond market, when you have a big buyer, bond prices go up, interest rates go down. When you have a seller or somebody who the big buyer disappears, bond prices go down and interest rates go up. So we think as long as quantitative easing is going to continue to come to an end, that interest rates should return to a more long-term normal standpoint and be somewhere between 4% and 6%, just like they were pre-quantitative easing. So that would be our expectation. So a rate, close to 5% doesn't really surprise us too much with this. A rate going above 5% from a psychological standpoint, it's going to be a tough one for both the economy and the market. So we expect that to trigger potential fall off from that. We'll see. It's interesting though that on Wall Street, no sell side big firm was predicting, a 5% 10-year for this year or for next year, first quarter wise anyway. And so it's going to catch a lot of people by surprise. So we expect that to be sort of a little bit of a problem should that arise. But in general, I mean, because of valuations, because of the cash that's sitting out there, we think that investors in general our clients in particular, should keep their allocations close to their long-term strategics, looking for opportunities. I mean, if we do get further sell-off in the market, and we have a panic or capitulation type event, that would be an opportunity to overweight those more risky assets. Because remember, that cash is still out there and should support the market going forward. And if we get to if the cash comes off the sidelines quickly and suddenly we're sitting back in a pretty optimistic or euphoric area, the IPO market's all open, that would be an opportunity then to reduce those more risky assets. But we expect the inflation to be continuing to be the problem, and interest rates continue to stay at a higher level than most expect because of that. And so that's where we're kind of on the little bit of cautious side of things. But right now, just given valuations, it makes sense to sort of stay the course. So with that, I look forward to seeing you next time. Should you have any questions, please feel free, email me. My cell phone's right here. You can always give me a call. Again, my email address is right there. Thank you very much for your time. Take care.